Hello and welcome to this latest edition of Courses on Demand brought to you by Forex.Academy. In this course, we will be discussing volume in fantastic detail and outlining how we can perhaps use volume as an indicator for our technical analysis. There is, of course, inherent risk when trading in financial markets, so please, before we begin, do take a moment to familiarize yourself with the following disclaimer. Now, in focusing our attention to trading and volume, we will begin by asking ourselves the very important question, what is volume? Then we'll be looking at actually making some trading decisions on volume, and that will lead us nicely into having some fundamental and both technical discussion with volume scenarios. Then on that technical front, we will be looking at volume as technical support, and that will develop nicely into volume and asset classes. So volume as an indicator actually holds greater weight when discussing various different asset classes over the others. And finishing off with that, as we round up everything, we'll be looking at volume and looking to actually include it as our technical indicator with the formation of some trading strategies. So first and foremost, what is volume? Well, market volume relates to the amount of financial contracts or shares traded over a specific period of time. It is usually indicated by colored columns for each trading time period, highlighting the level of trading activity conducted by market participants. So that's really the key, guys. Market participation. What is volume? Well, it's a level of judging and analyzing the activity, the market participation for each trading period. It is one of the oldest and most popular indicators used and is technically significant as it is one of the very few indicators that is not based on the price itself. Let's have a look at a price chart here. Both below and above, we see the price as it moves from left to right, and following the price for each particular trading day is the volume. So what we can see, trading volume for each trading period, and as the market trades, the volume signals the level of trading activity for that particular time period. So it's quite simple as an indicator. Now, what is significant if we just use our Epic pen is that it is always following price, but doesn't necessarily have to follow the actual price candlestick itself. We'll develop this throughout this lesson. Here is just one example I'd like to point out. It's a very significant candle, yet we see an increase in volume above these levels here just before. Now that may seem significant, however, also we see a very high, it's the highest level of volume activity throughout the range here, throughout the trading range. And here the candle is actually not very significant in terms of price direction. So there's a bit of both there. It doesn't necessarily, it needs to be judged and doesn't necessarily mean that because there's a very strong increase in volume, well, price is certainly going to move in that way. We need to judge the price action with the level of volume activity for that particular trading day. Now, given an increase in volume is simply an increase in trading activity, we can say that the market is experiencing a higher level of interest. So let's think of it as that. A higher increase in volume is simply a higher level of market interest in that instrument. Technical traders do not ask why, but understand that this sudden increase in trading volume points to a higher probability of price changing. And remember, as always, as technical analysts, all we're trying to do is stack the odds in our favor and have a higher probability of price changing in our direction. A good example would be economic news events. Economic news events are typical moments when the market experiences a sudden surge in volume. The increased participation is often a result of large institutional traders positioning in response to the news. The early formation of trends often follow, and that's certainly the case. Let's say we're looking towards a non-farm payroll event, usually the last Friday of each month, and it becomes a very strong figure, unemployment figure for the growth of the US economy. Well, we're going to have the big financial institutions coming in, placing trades, perhaps taking long-term positions based on the economic figure, and then we'll see price follow thereafter in that price direction. That will be indicative of an increase in the level of volume. So how can we trade on volume and how can we identify the highest probability of price changes as a result? An extensively large increase in volume in relation to the norm or average levels of volume. The level of congestion leading up to the volume increase. The structure of the Japanese candlestick during that single trading period. So we look at the volume and we look at the Japanese candlestick and see what story that tells us in terms of the market trading and the price action thereafter that follows the aftermath of the high volume period. Now let's look at some volume scenarios. Fundamentally, of course, first, we will attempt to profit from changes in market prices, but we must be alert to when large market participants enter the market and are likely to cause long-term price changes. So case number one, fundamental case number one, January 22nd, 2015, European Central Bank President Mario Draghi announces a 1.1 trillion euro quantitative easing program. Now, what did that mean for the market? Well, in recovering from the previous recession, what we've seen, the European Central Bank announced that it would begin a program of public and private asset purchases in an attempt to support or buoy up the economy. In practice, what had actually happened, cash money was printed and exchanged via debt instruments, basically the bond market, for other bad debt circulating the economy. As the policy was aimed at supporting European equities, a massive increase in volume was seen across European asset classes, including the stock markets and the euro currency. So just think about that for a moment. We're trading US and we're perhaps trading European equities specifically, and we know there's going to be a massive increase of volume entering the market in support of those equities. Where is the market more likely to move to? And do we become a buyer or a seller? Well, certainly we become a buyer if we know that large institutions and central banks are going to be coming in, buying up these assets, leading to long-term price increases. Let's have a look at case number two. This is particularly the WTI crude oil market. May 25th, 2017, OPEC and non-OPEC members agree extension on oil production cuts. Now, what happened in this scenario? In battling the oil supply glut, oil-producing nations agreed to extend oil cuts only until 2018. The fundamental aim was to rebalance the supply side of the market and bring oil prices back to stable levels. That was the objective, bring oil prices back to stable levels. We can see how the market reacts with a huge surge in volume and an extended 4% plunge in oil prices. That's a 4% plunge to the downside in oil prices initially. In openly establishing the aim here from OPEC and non-OPEC members, the decision tackled the fundamental concerns of lower oil prices and signaled to the market a large resumption of volume in oil trading then occurred. So that signal, we're going to see OPEC making these fundamental decisions. There's going to be an increase in volume one way or another. How does the market react to that? Well, let's have a look at the fundamental case number two, WTI crude oil market, and can we see where the volume increases and how significant is that in terms of both price action in that trading period and over the long term? Well, point number one. Now, as the story develops, we'll see price move. OPEC announces the cuts, the extension cuts only until 2018. Market then prices in and believes OPEC is not doing enough to curb the oil slide. At that time, it was believed they would increase cuts to 2020. So 2018 perhaps wasn't enough, and we see within the 25th of May, that trading period here is very significant. If we just use our epic pen to point out this trading time period here, this daily candlestick is very, very bearish, engulfing Mariposa to the downside. That then leads to long-term price declines and hitting the low here around the 26th of June. But what is significant is actually our huge surge in volume here. And we see that within our trading period, we see huge price movement to the downside. We've seen a huge surge in volume. And just look where our average volume low is here. Very, very low volume over the long term in the oil market. We see this volume totally eclipse the trading within that 1 day period, and that leads to short-term price declines given the news events. Now, as we move on, the story unfolds. OPEC comments and certainly suggests to the market that, look, this price stability, guys, it is a fundamental decision. It's going to take time to actually affect the market. What we see is a resumption of oil trading as the market prices that in and understands that this fundamental factor is not going to happen overnight. We need stability to come into the market over perhaps a 3 to 6 to 9 month period. And that's certainly what happens technically. If we look at our price charting again, we see a very strong increase from this moment as we recover from the lows here and hit this little block. Within this period, it's significant because price does not eclipse new highs, the highs before the 25th of May announcement. We see it stabilize, albeit below the level. But what we see significant is a very, very large increase in volume from low nominal levels. Now, as the story evidently moves on, what we see is prices stabilizing. Oil volume doubles from previous levels, leading to a confirmed trend line. So, if the objective is not necessarily a quick price rise in the oil market, it's price stability. That is telling the story technically in this chart. That is exactly what we can see with a huge volume increase over the long period, leading to price stability. We also see large levels just at these price structural lows, and that is the very start, of course, to our long-term trend to the upside in the oil market. So very technically significant when judging the price action with the volume increase in the oil market, leading to long-term price reversals to the upside. Let's look at technically some volume scenarios. A very simple chart here, but we can discuss it technically with the volume as it follows the price action for each trading day. Here to the left, we have a low volume period. Now, why is this technically significant? Well, let's just judge the story behind the market itself. The market is trading here. It's actually quite a large candlestick to the downside. But what this would suggest when we read into it is that, well, it's still quite a low volume day, not the most convincing sell-off to the downside. As the market continues to trade on, what we see is low volume, low interest levels, and what we begin to see is a little bit of price consolidation at these low levels of interest or volume, indicative of these volume levels here, just in the circles. So we don't really have any indication to price rises or to a volume increase at this stage. When are the big players going to come back in this market and actually move the market either to the downside or to the upside? Well, as the market actually continues to develop and trade on, that story is foretold with actually the decision candle. So just why this is so technically significant again, this is quite a large trading day. We see a low level of volume. This is a very low in terms of average true range, a very low interest trading day. But is it really? When we see the large increase in volume, that tells us another story. Now, it's not the most convincing trade to the upside. What we need to understand is the aftermath of this daily candlestick. We see a bullish close, albeit not convincing, but look at the volume again. Very, very high level of interest coming back into the markets. Evidently, it never falters within this price action, leading to confirmed trading to the upside. Again, we finish on new highs. So we can see that this level here, the actual volume increase continues to move on. We have an engulfing Mariposa and we have an increase in volume here. Very convincing volume structure leading to the price action as well, supplementing a very strong trade to the upside. So as we look at the technical scenario there, in observing some technical scenarios, we're reminded that we must analyze the volume with the price action to determine what the market reaction is. So it always tells a story. Each Japanese candlestick always tells a story. Volume is only one part of that story. The Japanese candlestick structure is only one part of that story. But certainly when we combine them both, we get, a full story of where market prices want to move, but also where are the market participants coming from? Where is that level of participation and how high or low is it? Let's look at volume with technical support. Technical traders observe the volume around key levels of support and resistance. These levels may be long-term price interest points over a long time period, or technical support levels such as an indicator like a Fibonacci retracement. These levels can often cause a congestion of trading. And what this is known as, guys, is price consolidation. An increase in volume is often seen as the early sign of a trend as prices push away or move away strongly from consolidation and they find price direction. Let's look at this in some detail and just discuss it very briefly. Just above here, we have a very, very well confirmed, technically very well confirmed um, level of technical support and resistance, and we see that price consolidating just above the level. So above, what we see here is the market trading down on various occasions. I'll just use my pen to highlight. Obviously, we can see with the black S's for support, the market actually trades down past the level and actually continues to trade up again. And that is indicative of each one of these time periods here. We see the market trade down, trade up, and close above the level. Here, it's very volatile within this price action again, but not convincing to either way. And again, 1, 2, 3 with these candlesticks, it's rejecting the downside. This is a very, very conformative level of price resistance, where traders do try and force the price below this level, but it does not want to close below the level, and effectively above our price level. Technical support is very strong indeed. Now, what does that mean when prices actually trade below the level and close below the level? Well, it's very significant. So the candlestick itself is very significant because in this example, we have a bearish, very, very strong sign that the market is continuing to trade down. And what we see is, if I just use my Epic pen here again, I'll use a different color to depict that. What we actually see is the market closing below the level here and continuing to trade. Why is this significant in terms of using volume as a technical support? Well, evidently we see volume rising above these levels here, volume rising above nominal levels, and again here we get a close where volume is actually very, very high indeed. I do believe it's our highest level of volume, trading volume for the given range. So very technically significant indeed. And as prices close and continue to trade below the level, volume is still quite high. So that gives us a sign as we go back to our fundamental discussion. The level of interest or participation, the level of agreement between traders seems to conform that evidently we've closed below the level and we're not retracing. We're happy below the level and prices may shift. So eventually the trading congestion leads to a breakout and creates new price direction. This is also supported by an increase in volume to the downside, as we can see in the chart. Let's have a look at the cocoa market here. So we have our two levels of long-term price support here, two technical support levels, both a ceiling above here at 2171 and a floor technical support at 1798. And as you can see, there is a long-term level of price congestion between actually trading these candlesticks. We can see the price does break down, but we see a long zigzag price congestion, no real structure until we get to these levels here. Can we decide, well, this is the second time we've actually been towards these price levels here, 2171. How is prices going to react? How is volume going to react? And what story does that tell us in terms of price action and future trading momentum? Well, let's have a look in a little detail here. We see at point A, we see the market break up, and what significance is that in terms of volume? Well, we have low volume. It actually causes a false breakout and trades to the downside. And there, just below point A, we can see volume. It actually decreases as the market breaks up to the upside. Then we see the market continue to trade with an increased low level of volume until we actually move forward as the market trades. We see very, very low average volume with a break up to the upside, evidently as the market comes back to our long-term price point. Just here below, we see B breaking up to new prices, and that is supported again actually by an increase in volume, actually resulting to the breakout to the upside. We can see a very low level of volume, and then as we shift towards our long-term price resistance level, volume pushes us through that level and actually closes above it. Now we're away to the upside. So very, very significant in this chart using volume to indicate a breakthrough through technical support. As market volume relates to the amount of financial contracts or shares traded over a specific period of time, it has very significant characteristics in relation to different asset classes. The Forex markets certainly have the most total volume with billions of dollars of currency trading each and every day. The reasons for a change in volume in the Forex markets is unquantifiable. So looking across these asset classes, it's very, very difficult in terms of Forex trading when we see increases of volume to understand why that is the case. And therefore, it's very difficult to look for a consistent trading decisions in the Forex markets. Massive amounts of business conducted in the Forex markets are actually for hedging natural currency positions and do not actually provide any reason to speculate on price change. So as technical traders, when we see perhaps a little increase in volume in the Forex markets, we can take it with a little more pinch of salt in terms of trading Forex as opposed to other asset classes. And that's very, very important indeed. Now, I want to move that on just to actually giving you the reverse sign of that, and that would be equity trading. Why is it significant or more significant in actually looking across asset classes in terms of equity trading? Well, if we think of a large increase in transaction volume for any particular company, means that the market is showing an increasing level of interest in trading those company shares. Whether the volume is particularly one-sided, and what that means is buy side or sell side in terms of a one-sided opinion, is hugely important to anyone either trading or owning those shares. So why would that be important? Obviously, if we own shares in Societe Generale or perhaps Google there at the bottom, if we own those shares and we know that there's a huge increase in volume to the sell side, well, we need to ask ourselves why, and we need to perhaps consider selling our shares if it's very, very bad news, or looking for perhaps if it's not bad news, buying opportunities. So if we can identify why the volume has increased and whether it will likely have a positive or negative effect on the price, we are able to speculate on price movement as a direct result from that increase in volume. Very significant volume in terms of equity trading indeed. Now, to put all this together, let's have a quick look at actually using volume as trading strategies. What I want to do is highlight 3 ways to improve your trading strategy using volume as an indicator. Using volume to confirm trends. Using volume to confirm breakouts. And using volume to identify reversals. So first and foremost, let's understand the concept of using volume to confirm trends. An increase of volume means that there are a greater number of market participants in agreement about the price movement it coincides with. So simply, a greater number of market traders agree that the price is moving in this direction. The same applies when market begins trending in a primary direction. Okay, so as we have a more mature trend, there's a more constructive level of agreement between traders, and that actually looks toward the volume to say, well, as traders come together, the trend is very, very well defined. There's more belief, there's more volume interaction with this instrument in particular, and that will lead to continuation of the trend. During a strong trend, we commonly see volume increase when price is moving in the direction of the trend, and volume decrease when price is moving counter to the trend. When this occurs, traders believe the trend is more convincing and will act as a signal that the trend is more likely to continue. Absolutely. And it's worth noting that it's actually the opposite. So the greater the disparity in volume during trend and counter trend moves, the stronger the trend. Okay. Volume trading strategies, using volume to confirm breakouts. Now, we did have a look at the cocoa market within this lesson to actually look for a confirmation of breakouts. One of the greatest fears for traders is encountering a false breakout, actually buying the top of a candle that will reverse and result in a loss. This is when price breaks a major support of level of resistance, but then reverses to the original side. To mitigate falling for a false breakout, traders often wait until the current candle actually closes beyond the support or resistance level before placing the trade. This is a good technique, but requires waiting for confirmation. So that's certainly worth noting. A good technique is to wait for the close of the candle to give you that confirmation. However, it requires you waiting, and you often most likely will get a poorer price or not able to preempt the trade as you have to wait until the market closes above the level of support and resistance, or below, depending um, where you're trading, or what trade position you're taking. We can actually do this in another method. Another way we can confirm a breakout is by using volume. During a breakout, it is common to see a spike in volume, which is simply an increase in volume. And this increase in volume represents a larger amount of participants that agree with the breakout that is occurring, and can actually act as confirmation, another earlier sign of confirmation that price could continue to move in the direction of the breakout. And of course, using volume to identify reversals. Volume can be helpful in identifying potential reversals. Why could that be helpful? Well, trends do not last forever. We know that as traders, trends do not last forever. At some point, a reversal will take place. Traders then will look at these opportunities in much more mature trends. Given that trends don't last forever, a very mature trend, particularly in an asset class such as a forex market where there's a lot more volatility, we look for actually looking for pullbacks or trend reversals. But timing a reversal, we know it's very difficult and very costly when we are wrong. Volume can be used to assist us in identifying reversals by looking for times when volume is decreasing at the same time the trend is beginning to stall. So it's very important. As volume is decreasing within the trend, as momentum starts to fade, we can look at the price action, tie in the volume story with the price action, and actually look to see when that reversal happens, or preempt that reversal with a low introduction of volume into the trend. And as the pullback starts to begin, or perhaps we see some reverse candlestick price action, a small increase in volume, then we can look to actually identify that as a long-term reversal. So that finishes off with a very, very nice three constructive trading strategies, both trading with the trend, using volume to identify a reversal of that trend, and obviously using volume to identify the breakout opportunities within those areas of levels of support and resistance. So that concludes our study on trading on volume. At this stage, we should certainly understand the concept of volume and its impact on price. We should certainly understand how volume can affect both the market, both fundamentally and technically, with our volume scenarios. Using technical support, we know on how to use volume strategically to help stack the odds in our favor as technical traders. So as that concludes our lesson, thank you very much for joining us on this installment of Forex.Academy Courses on Demand. We do hope to see you again very soon. Bye for now.